All right, good afternoon, everybody. My name is Brad Compere. I'm the founder and CEO with Capstone Title, and I want to thank everybody for joining us today. I'm pleased to bring Sam Tenenbaum on the webinar for y'all. Sam is a friend of mine. We both are members of ULI. We both serve on a local member council for multifamily real estate. So Sam and I have gotten to know each other pretty well over the last year and a half through that group. And Sam is a very active member in our group and a big contributor. So we're real lucky to have him. Sam's been with CoStar Group, a real estate analytics group, for about 8 years, if I recall correctly. And Sam serves as an economist for CoStar and is regularly asked to speak to groups around Austin and Central Texas area, and as well as contribute to articles for the Statesman and the Wall Street Journal, among others. So we're real pleased to have Sam, and I thank you, Sam, so much for your time today. We appreciate you being here, and I'm going to turn it over to Sam.
Awesome. I will get started sharing my screen here in a second. Can you see these slides? We're all good there? Awesome.
Yes.
Cool. Well, so thanks, Brad, for inviting me and for setting this up. Really, from all of us here at CoStar, and I think I speak for the broader company. And when I say, I hope everybody who's watching this is safe and healthy, and follow social distancing. I think that's pretty fair to say, even though it might be opening up. So with that said, let's get started here. I'm going to talk mostly about Austin. I've got a slide on San Antonio just as a quick note as something that's interesting that's happening to our neighbor to the south. But I think it really behooves us to start by saying everything we talk about today, everything related to the coronavirus has so much uncertainty tied to it that it really all depends on how this plays out. So what you'll see on the x-axis is the economic policy response. So, and the y-axis there is the virus and public health response. So this is sort of the range of outcomes that McKinsey kind of outlines as what their GDP forecast-ish kind of looks like. Depending on whether or not you think everything will be terrible, we'll have the economic interventions maybe won't be enough, and the public health responses, for lack of a better term, failure. We're looking very much like an L-shaped response versus, if we are effective in all cases, it's more of a V kind of shape. We'll talk about sort of our outlook on that, but it's worth starting with, again, everything depending on sort of that range of outcomes and where, you, the viewer, kind of feel that this will play out. I think it's also worth starting with what we actually know. Right, because there's a lot of stuff we don't know, so let's focus on the things that we do know and be able to talk about that stuff. So the ADP just released their new job numbers this morning. So this is not inclusive of the latest data point. You can see here the scale goes from positive 1 million to negative 1 million, going back to 2003. If we include this month's number at minus 20 million, you can see it blows everything out of proportion here. And that's really, to speak to how unprecedented this is. This is the worst monthly job loss we've seen based on ADP numbers since they started tracking it. If this was actually the official government stated numbers, which there's a pretty good correlation between this and the ultimate reported numbers, this just happened to come out today, this would be the worst month for job losses since the Great Depression. I mean, we're talking incredible loss when it comes to jobs, to incomes, and things like that. It's worth noting too that this is 20 million job losses. So I'm sure folks have seen the stories of 30 million uninsured claims. There's clearly a difference between those two, but 20 million job losses is definitely significant, and definitely what we expect to see given those unemployment claims. If we look at what sectors those losses were in, this is sort of how ADP breaks this out. You can see huge losses in particular in this leisure and hospitality space. That's not just hotels, that's also bars and restaurants as well. The trade, transportation, and utility sector, that's mostly retail trade. We see a lot of job losses there. Limited job losses in information. One, it's a smaller sector. Two, it also is a fairly good proxy for tech nationally. And this professional and business services, we'll talk about that as it relates to Austin as we move forward. But worth noting, of course, the losses are pretty much where we expected them to be in the leisure and hospitality and the trade, transportation, and utility sector, which again is mostly that retail trade. It's also, we've finally seen GDP losses for the first time since, in this case, 2014, but for the most significant since the last recession. If you look at personal consumption, that's clearly driven a lot of the losses this cycle, this last quarter. That represents typically about 70% of our GDP, so it's an incredibly important sector and it has a ton of weight attached to it. So you'll see that's really what's driven a lot of the losses as folks lose confidence in spending, they lose their job, they're not clear on what they're going to do, they're not about to go buy another car or things like that. It's also worth noting though that where that GDP loss came from has mostly been, if you look all the way over here, this line is healthcare. So we have a minus almost about 2.25 loss in healthcare, which is almost half of all of the GDP losses we saw in the first quarter. That's for people not going to the doctor's office, for people not, proceeding with elective surgeries, things like that. So the healthcare spending has really, really been reduced, as you might expect. Part of that is government driven, right? One of the things that Governor Abbott had said when he first announced his first round of opening is that folks could do elective surgeries as long as it didn't take a bed away from a potential COVID patient, right? So, you're sort of having this government imposed shutdown around healthcare in particular. It's drastically impacted, sort of how Americans spend money in the first quarter. We expect obviously that to continue, but for the most part, that'll just be a short-term problem. Broadly speaking, as a national economy, we're graying, we're getting older. This is the growth showing people aged 70 years and older. You'll see that the growth projections are pretty robust. Just as baby boomers age up, they're going to demand more healthcare, which means that broadly speaking, these losses, at least for the time being in this particular sector, are probably relatively short-lived. At least hopefully. But here in Texas, we're back open again. So this was announced a week or so ago that malls, movie theaters, restaurants, and museums, among a few other businesses, can open at 25% capacity. There have been a few other businesses that have just got announced either yesterday or late last week. From what I've seen, there's been an incredibly low appetite to open at 25% capacity. Most restaurants and small businesses don't, barely squeak by at 100% capacity. So opening at 25% capacity, particularly given that your employees wouldn't be able to qualify for unemployment benefits if they felt uncomfortable coming back to work, for you to just continue losing money. It didn't really make a lot of financial sense for a lot of these small businesses to go about doing that. It's not to say that we won't see more and more folks open. Some things I've seen have just said we just need some more time to plan around what this might look like. But that said, until I think, we open this up a little bit more than 25% capacity, I think we're going to still see, the bars, the restaurants, the small businesses stay relatively closed, given, the restrictions in place. It's also worth noting about where Texas gets its money. So we here in Austin are obviously dramatically affected by government spending. It is an incredibly important thing to the Texas Capitol. So if we look at where Texas gets its money, it might give us some inclination for what future hiring plans might be post-virus, right? Are we going to need a new public health department? Well, how are we going to pay for it? How are we going to increase staffing for that kind of thing? So if we look at Texas here, you'll see that between general sales tax and selective sales tax, which is like alcohol, tobacco, firearms, that kind of stuff, and severance, which is really taxes on natural resource drilling, basically oil. That's about 95% of Texas's revenue. That's quite a lot. It is a very significant portion of how we get it. And it's not to say, look, that we're going to have zero sales tax revenue. Clearly, people are still going to the grocery stores, people are still buying things, but it's going to be dramatically reduced. And Texas has a balanced budget amendment in the Constitution, which says that every time the legislative session meets, they have to produce a balanced budget. It's going to be really hard to balance a budget without resulting in job losses and things like that, given some of the preliminary numbers I'm seeing on the retail sales figures for Texas. It's expected that revenue is going to drop pretty precipitously, which might impact future growth of the state government and the ability of the state to maybe attract and retain companies as well, right? If we don't have a ton of money, it's probably not likely that we're going to send the governor on trips to go recruit a bunch of businesses to come to Texas, even if it makes financial sense to do so from an investment standpoint. It might just cost too much money to keep doing that kind of thing. And now that we're opening, it's also worth considering what Oxford Economics, which is our economic data provider, calls the double dip scenario. So you can see this dotted line here. That's the pre-virus GDP path. Broadly speaking, their baseline for April says we kind of get close to that pre-pandemic growth path. Ideally, we'll get back to the 2019 Q4 level by early next year, basically. But in this double dip scenario where we open, but there's sort of this false start, the actual knock-on effects of that, as you can see here, are pretty significant, right? Where we open a little bit, we get this little bit of pop of GDP as people go out and spend money, and then the virus reemerges in winter. And we have to go back through this whole thing again. People are frustrated by it. People really get concerned because now they're really not sure if their job's going to come back, and maybe they just won't. And there's maybe not enough money left to fund a stimulus plan or something like that. You can see what that does to the economic outlook. So it's not to say that that's exactly what's going to happen, but it's definitely worth considering as a possible outcome as a result of this. As I mentioned early on in the outset, here are the unemployment claims for just Texas alone. This is every year through March. I've added so far the data that's available through April. You can see that April has dwarfed March, about 870,000 claims in April alone. That's on top of the almost 600,000 claims we've had since up until March. We're looking at some really robust losses in jobs across Texas. Clearly, we're definitely not immune in Austin. We'll talk about some of the local job figures in Austin too, but it's worth noting, we're definitely not immune. In fact, here is monthly job growth seasonally adjusted. We have March data now. It was the worst month for job losses since the tech. Now, it's worth noting that says a lot about how we did during the last recession. We did pretty well here in Austin, so the losses just weren't as bad. But we're expecting that April job numbers. We talked about the ADP April job numbers coming out this morning at a national level. We're expecting really bad losses for Q2 in Austin, particularly. If we look at the sectors where those jobs were lost, you can see it's exactly where you'd expect, right? That leisure and hospitality sector leading the way in terms of losses, but the education and health services sector also seeing some layoffs as well, right? That is what we talked about earlier with the healthcare folks. It's really, no one's going to see their dentist at a time like this. So a lot of those hygienists and things like that support those kinds of ancillary, less important doctors' offices in a pandemic, certainly not important. But in a time like this, they're seeing losses as well, which is reflected obviously in that national GDP. So here's our baseline forecast produced by Oxford Economics. As I mentioned, here is some fairly robust losses in Q2, but by and large, they're mostly made up, by the end of 2021, maybe early 2022. You can see obviously that this kind of blows the scale out, and the recovery kind of picks that back up. But, if we consider what a severe downside looks like, that's pretty similar to that double dip scenario, except for the fact that it's not worse the second time. But we just sort of have losses that aren't made up by 2024. I personally think this is a bit bearish. But it's worth, like I said, depending on the public health outcomes and the economic intervention outcomes, this is a possibility. The reason that I think this is a bit bearish is if you look at performance of the S&P by sector year to date, information technology all the way here on the right side is actually up year to date, whereas the broader S&P is down about 11%. So obviously we all know that tech plays a big part in Austin's growth. That's really important. It's particularly, or it's shown to be particularly immune from these losses. They're a little bit quicker to pivot to work from home, obviously more reliant on digital, the digital world as part of entertainment and all of the other things as well. That said, we're definitely not immune. Obviously Expedia, HomeAway, Vrbo, that conglomerate of things is slow rolling their build out on their space. In the domain, they occupy about 750,000 square feet. So it's not an insignificant tenant in Austin. And that is a real risk factor, as we'll talk about a little bit. Here, though, we've mapped where people live that work in retail or hospitality. So you'll see here that this is obviously by census block as well, or census tract. You'll see a lot of folks live in South Austin here, down in Kyle, but also up in Round Rock close to Georgetown, and primarily also along 183. If you kind of follow 183 here, down here, it's kind of what you'd expect to see where folks live that work in retail or hospitality as well. But those are the areas that are probably most exposed, particularly on the multifamily side of the equation. Which brings us to talking about sort of the CRE markets. So I thought I'd give a brief summary of what we've seen so far, but the real crux of this is a lot of this data that we would expect to see is kind of lagged. So we haven't seen a huge uptick in vacancy. We haven't seen a huge uptick in all across any property type. We haven't seen this huge downward pressure on rents in any particular property type outside of multifamily, but that's a different story, and we'll talk about that. But a lot of the reasons for that is that there are deals still getting done, but there's a lag in the data. So we'll know, in a month or two, we'll have a better sense of what occupancies will do. It's also hard because most people are taking a wait and see approach, as I share in this chart. There have been about 300 leases signed since March across office, retail, industrial, including Amazon's lease of 300,000 square feet in Utah on March 16th, right at the outset of this crisis. Probably great timing for Amazon to get that facility up and running as more people look towards e-commerce. There have been about 50 sales transactions above a certain size since March across all property types. That's pretty light in the grand scheme of things. So I think we're seeing the investment market kind of pull back. In particular, a handful of deals have really been pulled from the market, namely, or probably the biggest one being the Whitley, the biggest, one of the big apartment tower downtown, an office tower downtown as well, got pulled. The bid-ask spread, so what people want versus what people are asking for, what people want to pay versus what people are asking for, has been pretty wide. It's been pretty blown out from what I've heard. It's also really hard to underwrite, rent collection in particular right now, but on the lending side, on the investor side, it's just really hard to underwrite what the near-term outlook looks like. And obviously, the triple P program has been a huge priority for the lending community. Some of the lenders that are on our ULI council, as Brad knows, are really tied up with those triple Ps, getting inundated with requests. It's sort of an all hands on deck thing, which means unless you've got a really great relationship that's been long-term with your banker, it's been really hard to get your banker to pay attention to anything other than the triple P program right now. So these are just some office-related headlines that have popped up in recent history here. That one on the left there, this is Brandywine. One thing to note is that their lead tenant, which is DLA Piper, had pulled out of their building they were building at 4th and Colorado, or 405 Colorado is the actual address. They were in about 70,000, they pre-committed to about 70,000 square feet. They've since reportedly moved to the Colorado Tower, just a block south, to take some occupied space already by Parsley Energy. I think that's sort of the trade-off that they're making there. But it's basically, there were huge delays as a result of the I don't want to say miscommunication, but the the sort of uncertainty around construction being an essential service. Obviously in Austin, it was considered not until the governor stepped in, and then it was. So just the sort of those delays, in addition to supply chain issues, in addition to just less efficient, as a result of social distancing, really has meant delays in construction projects across the board, but obviously affecting pre-leasing in this particular building. We also talked about Verbo / HomeAway / Expedia, it's all the same company, slow rolling the construction and their finish of their high rise at the Domain. As I mentioned, they're occupied about 750,000 square feet. That's probably the most exposed tech tenant of size in Austin, but worth watching sort of how that plays out, in particular in and around the Domain. One thing that worried me at the outset of the crisis is this is Josh Baer. For those that don't know who Josh Baer is, he's the head of the Capital Factory, which is probably Austin's most important startup incubator. So this was a thread he had in early April. In particular, I thought this second part of the quote was particularly relevant and concerning, right? Basically, this was right after Airbnb's valuation got cut in half. His message to founders as part of the Capital Factory community and just founders in general that follow him on Twitter is expect 50% of the valuation they planned. That's particularly rough here in Austin, right? If you have to plan for a 50% drop in value for your company, what does that do to your growth trajectory? What does that do to your hiring plans? What does that do to your space needs? It has huge ramifications. But it's worth noting that very recently, in particular, Silverton Partners, which is a pretty big VC company here in Austin, just finished raising a lot of money to deploy as part of their VC fund, which I think is really important for growth trajectory. It may mean that they're trying to find more value, but at least people are still raising money to provide venture capital to those smaller companies to help them grow and get bigger. If you look at that last quote there, it says, we're absolutely looking to invest. Some of the best investments we've made at the firm have come at these kinds of times. So I mean, that says, one, they're probably looking to take advantage of some lower pricing opportunities in some of that startup space, but the fact that they're still here and willing to invest in those companies, I think, speaks volumes about the growth potential for Austin moving forward. One thing that does a little bit concern me, though, is that the sublease space across the Austin office market is rising. So this is a very important metric that we track pretty closely. So sublease space is when a company commits to a space, then decides they don't actually need all of that space and puts it up for lease, even though they're still paying rent to the landlord. So it's a good indicator of companies that maybe overstretched, leased too much space, and now realize their growth plans have changed as a result of coronavirus, and now maybe they don't need that 50,000 square feet they lease. They only really need about 30,000. So they're going to put 20,000 back on the market. But if you see that over and over and over again, you start to see a market kind of unwind. You can see what happened during the last great financial crisis. The reason I'm not particularly worried is that there's been this kind of steady increasing trend in this data since 2014. So it's not like we saw a huge rocket ship up in Q1 in terms of sublease space, but it is concerning because it seemed to be coming down a little bit at the end of 2019, then to rise only again at the start of the year. A little bit concerning, definitely something we'll be watching over time. So the other thing that's worth mentioning, of course, is that we at CoStar own apartments.com, which is the largest listing site out there for apartments. It's how we're able to get about 120,000 rent observations each day in Austin alone. What you'll see from that data, though, is, so here is daily asking rent trends for Austin. They are definitely down since the outset of the crisis. This is about 2 full % in terms of this peak here and where we are today. You'll see it's also lower than where we were last year. For the first time in a long time, we've seen rents actually fall year over year, which is pretty unlike Austin. It's also particularly worth noting that it doesn't usually happen at this time of year as well. This is showing week over week change in rent. These are past years, this is this year. You'll see normally at this time of year, we're starting to see rent growth ramp up in preparation for that summer leasing season. We're really not seeing that this year, obviously, in light of the coronavirus. But what is maybe encouraging, and we'll talk about it in a little bit, is it appears to be slowing. You'll see this hook here at the end. that means that the rate of losses is slowing a little bit. We're not talking about rents flatlining yet, but we're definitely seeing rents fall in the multifamily space. The reason we can present this, obviously, is our wealth of data in the multifamily space. It's just not able to get that frequency of observation in the other property types, which is why we can't say, retail rents today are down, 10% or something like that. We just don't have enough data there. So I thought it's worth ending here with some good news that we've seen in the market. So this is the San Antonio chart that I alluded to earlier. Same thing, the daily asking apartment rents. We've seen their rents bottom out and even start to increase a little bit. So this to me says we're maybe near the bottom for a place like Austin. If San Antonio is starting to maybe see their rents rise slightly, we're not talking about huge rises here or anything like that, but we're starting to see it rise just a little bit. That to me says maybe we're at the tail end of the effects of this in Austin. The other thing that's really good is that people are still looking for apartments. One of the benefits of owning apartments.com is that we can take a look at what the search volume is on apartments.com. You'll see that today search volume is higher than it was prior to the crisis. That would be about here, would be sort of where the crisis is. You'll see over the last few weeks, we've seen a huge uptick in people looking for apartments. Maybe that's folks looking to downsize into something smaller or something more affordable or something like that. But the fact is that they're still looking for stuff. And the real important thing for us here in Austin is you'll see Austin at this top list here, at the top end of this graph here. What this shows here on this x-axis is people in that market looking for properties in other markets. So, and this y-axis here is people looking from other markets at that particular market. So what this is saying here is that people in Austin are not looking for apartments elsewhere, and people from elsewhere are really looking for apartments in Austin right now. That is incredible data and speaks to potential growth after the coronavirus ends, right? The more people we have, the more commercial real estate we're going to need across the board, regardless of property type. Retail's a little different, hotel's a little different, but broadly speaking, if you have more people, that means more goods are going to need to be bought, which generally, should support, continued demand for retail space. I also have this chart here, which mentions San Antonio. This is looking at domestic migration. So last year in 2019, the last full year where we have data, Austin grew at 2.8%, but 2/3 of that growth came from people moving to Austin from somewhere else. That's this blue bar down here. You'll see it's not a percentage, but close to 40,000 people moved to Austin last year, just from other places in the US, not from international migration, just from people picking up from California or New York or Boston and moving to Austin. Not surprising, we all know that happens. It's also worth noting that was the best year for migration since 2007 for domestic migration. Really, really encouraging growth in 2019. In general, for 2020, our expectation for domestic migration is going to look a lot more like 2010, though. People aren't able to move right now. Not everybody can pick up and move to Austin, particularly since they can't really get on a plane right now, or most people probably wouldn't want to get on a plane right now. Makes it a little harder to pick up and move. So generally, our expectation for 2010 or for 2020 looks a lot like 2010, when Austin's population growth was 1.3%. You'll remember I just said that it's 2.8% in 2019. So we're looking at less than half the growth we saw back in 2010 is what we saw in 2019. So our expectation is maybe not 1.3, maybe not 2, probably somewhere in between there. We're looking at some pretty reduced growth in 2020. That said, the data from apartments.com suggests that maybe in late 2020 and early 2021, we'll see really robust growth for Austin, hopefully. And last but not least, I think it's worth kind of leaving on this note too, a similar hook that we saw in that multifamily data in terms of rent. This is people looking for the phrase, how to file for unemployment. Now we've seen the number of folks filing for unemployment, the nominal number of people filing for unemployment has come down. Still people are losing jobs, but the rate in which people are filing for unemployment seems to be reduced. That's really mirrored in this Google search trends activity. Maybe it just means that a lot of people have figured it out, but worth noting that we're probably through the worst of the job losses, the announcements and things like that, which means we should be on our way to recovery, hopefully, as we move forward. And with That I'll mention hang in there, but if you do have any questions, now's the time.
Okay, thank you, Sam. Let me see what we've got. I actually have a couple, if you don't mind.
Sure.
You mentioned, leisure and hospitality having the largest losses and job losses. How do you see that those areas bouncing back?
It's a great question. So I think, again, a lot of it depends on sort of how the pandemic plays out, right? I think a lot of the owners of those establishments, maybe have been able to get a PPP loan, maybe have been able to weather this storm. But, if coronavirus rears its ugly head again in, October or August or sometime in the future, we could be looking at like, well, we're just going to be dealing with this forever. Let's just cut our losses while we can and move on. Which would obviously be an incredible loss to a place like Austin, in particular, relative to, I think, some other places in the country, because we rely so much on that, local being this hottest new trend, at least in the past decade or so, as local as you can get, whether that's local farms, local restaurants, local retail, that kind of stuff. It's going to be really hard for those folks to bounce back if that is indeed the case. That said, if we are on this sort of road to recovery, we come with a vaccine, we're all sort of immune from this as time goes on. I think we can get back to normal. It's just been sort of this weird pause for a lot of people. It's worth noting that a lot of the job losses and the unemployment claims have been filed as temporary layoffs. So ideally they're short term. That said, if I'm a server in a restaurant or I work, in a retail store, I might be looking at another field of employment, much in the way that folks in the construction industry looked for another field of employment after the financial crisis last time.
Okay, I've got a question here from one of our attendees. Does the history of increasing and decreasing rent prices translate into new home buying? I.e., if rent doesn't go up, are people more likely to stay renting?
Not necessarily. I think people buy homes as a mix of a financial but also a personal decision, like a time of life. I think a lot of home buying is driven by, more demographic age type data than sort of what the apartment side is doing. I know folks are like, well, I'm tired of dealing with all these rent increases every year, tired of setting all this money on fire, I'm going to go buy a house. But you can't exactly make that decision at 23, or at least a lot of people can't make that decision at 23, I should say. I myself, I'm 30 years old. I'm married. I've been married for a couple of years. I just bought a house last Thanksgiving. It was a financial decision for sure, but it was also the right time of life to be looking and exploring that kind of behavior, which I think determines far more of the home buying pattern than before. There's some data. There's some other data that kind of supports that anecdote as well. The home ownership rate that's been ticking up for the last few years has mostly ticked up in that under 35 age cohort. So all those millennials that were never going to buy homes, it turns out they are indeed buying homes. What a wild world that is. But that to me says it's more about the age and the demographics than sort of what's going on in the rental market. I mean, one of the biggest selling home communities is in Gerald, Texas, north of Georgetown, where the average price is $170,000 a door, or for a house, not a door. Sorry, I'm mostly focused on the commercial side, so hence my use of door.
Apartment talk. Exactly.
So if the average price is $170,000 and they sold something like 700 homes last year, that's really interesting, but says to me more that it's not folks getting tired of paying rent and rent increases. It's more, there are a lot of people hitting that time of life in Austin, Texas, and are moving to a place that they can afford in Gerald, even if it means having to commute along 35 forever.
Well, so sort of on that note, I've heard some other economists, kind of more on a national scale, talk about there's going to be an increased demand for suburban living following all this, and that the urban vibe will be fading, so to speak, uh, and that the more dense areas were the ones that were seemed to be hardest hit with
Yeah.
COVID-19.
Yeah.
Do you see that this in this pandemic changing that trend?
I can certainly understand where, that theory comes from. The idea of being trapped in an 800 square foot box in downtown Austin when nothing is open isn't particularly appealing, right? I get that. That said, I think in particular here in Austin, until jobs migrate to the suburbs, and maybe they will, but honestly, we haven't built a ton of suburban office buildings with, no elevators, no, all the health things that you could want. That doesn't really exist in a lot of suburban office stock. A lot of that suburban office stock is older, which makes it difficult to retrofit for that kind of stuff. That said, there's clearly a ton of new construction in and around the urban core that's presumably in much healthier buildings and environments and things like that. So I think until we start to see jobs migrate to the suburbs, I don't think we'll see sort of the decay of the urban center, particularly in a place with such bad traffic as Austin has. I think, again, I think it depends on sort of what the virus does. To your earlier question, does it shut down retail? And now all the great bars and restaurants and retail that's in central Austin goes out of business and it's replaced by, I don't want to say the Dallasification of Austin, but you kind of know what I mean, sort of bigger chain stores and things like that come to fill the void. Does it make downtown living a little less exciting? For sure. But until we see that kind of thing happen, and until we see jobs start to migrate to the suburbs, I'm a little bearish on that theory, at least. I get the idea. I think there's a place for it. I think, places like Round Rock and Pflugerville and things like that probably should have more offices in general, just because I think people will get tired of commuting all the way into the city. But that said, until we start to see developers and tenants say, I want to be in Round Rock, it's at scale, clearly. There are obviously plenty of office tenants in Round Rock, including Dell, which is a fairly big employer in Austin. Until we start to see that happen en masse, it's going to be hard to see or to expect.
So, talking about the traffic and the commuting and how difficult that is in Central Texas and in Austin in particular, during this pandemic, a lot of people have been working remotely. And a lot of people seem to think that trend will continue and the demand for office space will decrease. What are your thoughts on that?
Yeah, so I'm today at my mother-in-law's house in Georgetown. She just moved up here right as the pandemic started. So it's been great. Like, I haven't had to deal with one iota of 35 traffic at all. And my wife and I constantly look at each other in the car saying, God, it's going to suck when people, have to go back to work and we're going to have to deal with plan when we leave and arrive and all that. I think we made it up in 40 minutes yesterday or something like that. At 6 o'clock, perfect analogy for your point there, Brad. But, I think honestly, most of it's probably going to be mixed. So some of the surveys we've seen of CFOs from a company called Gartner have done a survey about this particular topic. And this is the midst of the pandemic. So this is right as things were at their worst and you're going to get the most extreme answers you could probably get. A lot of the CFOs, I think 50% of the CFOs that were interviewed said that they would see a possible 5 to 10% of the workforce stay remote, whether that might be, 1 day a week you work from home or, you can work some amount of time at home, but come into the office the other days. I think, we will see a reduction in people going into offices for sure. That said, I think it might also be offset by some of the things that companies will have to do to maintain social distancing or just, make people feel comfortable coming into an office again. might mean that they need to take some more square footage to accommodate that fact, right? Because a lot of these companies have done sort of these open floor plans where there's a lot of ability to work from here, work from there, or hot desks, and all sorts of different concepts that have been out there that don't really work in a coronavirus world, right? The math doesn't add up to make sense of it. So the redesign of some of those workspaces might mean, they might not need a whole nother floor, but they might need, a little bit of extra elbow room for some of these people to feel comfortable coming back into the office. I also think there are incredible benefits of having people in an office together that I don't think can be replicated online. I, for one, grew up going to an office every day, picking somebody else's brain about one of those things that happen. There are tons of studies that show in-person interaction drives a lot of value for people. But I think, it might mean more sort of flexibility with the employer-employee relationship where, like, if you need to work from home, the employer now has paid for the infrastructure for you to do it and is more okay with it because they know you're responsible and have done it for the last, few months.
Yeah, I've heard a lot of people talk about that offset of, changing what does an office space look like and having the need for more space because of the need to keep people apart.
I think it'll probably net out around zero, but plus or minus a few percent, and depending on the company and the kind of work that they do and all that kind of stuff.
I think a lot of our office commercial brokers are going to like to hear that. Well, and we're almost out of time here. I know we wanted to keep this to 45 minutes, Sam. So I just want one more thing.
Sure.
One last question I think will be interesting to everybody is we've heard a lot about, or I've heard a lot about, as a result of this, a lot of the coastal cities, were harder hit than certainly we have been here in Austin, thankfully, for those of us in Austin.
At least so far.
And right, it's so far, and that as a result of this, we are likely going to see a lot more movement to Texas and then specifically Austin. Yeah. So, do you anticipate more movement as a result of this? And then obviously we're going to have some pent up demand with development kind of taking a pause. Mm-hmm. So, on the tail end of this, or as things open back up, do you see development really taking off again?
Of course, like everything, it kind of depends on how this plays out, right? If some of the things that I read sort of at the outset of coronavirus and this pandemic was about the flu of 1918, where, the cities that really accelerated their growth after the pandemic were those that effectively contained the outbreak. That's, speaks volumes about, the current levels of outbreak here in Austin and broadly across Texas as well, that they're pretty low in the grand scheme of outbreaks across the country. That said, we were the second state to announce that we were opening, and one of the things that Governor Abbott said to the state lawmakers reportedly was that, this next phase of allowing people to go get haircuts and things like that, will most likely result in an increase of cases. So, if we do have a double dip kind of cycle, I wouldn't expect a ton of people moving to Austin because we'd probably be, maybe not the center of another outbreak, but we would certainly see our caseload going up and few people want to move to a place where, the coronavirus is spreading rapidly. That said, if indeed we sort of stay on the trajectory we are, cases remain manageable, we're not getting our hospital systems overwhelmed. We just looked at the apartments.com search data. People are really looking for apartments in Austin right now from not Austin. So I would expect to see some pretty good pent up demand once this abates, depending on, sort of the public health outcome there. But again, in 2020, our expectation is pretty weak in terms of population growth, but ramping pretty back up considerably in 2021 and beyond, if indeed we do manage this crisis appropriately and sort of contain the virus here in Texas.
Well, Sam, we are out of time. Just wanted to say thank you so much for your time and expertise. Great having you here. Nice seeing you.
Thanks, Brad. You too.
And thank you everybody for joining us today. If you have any questions, feel free to reach out. Sam's info is right here on the screen. Or if you have any questions for me, please feel free to reach out. Hope everyone has a great day and is staying healthy. Thanks.
Thanks.